Level 1. Poor credit. You walk into the bank the same way anyone walks into a bank. You pull a number, you sit down, you wait. And when your name is finally called and you slide your documents across the desk, the conversation is shorter than you expected. Not because the banker is rude, not because anything dramatic happens, but because the system has already decided before you sat down. Your credit score is below 580. The algorithm flagged you before a human even looked at your file. The denial isn't personal. That's almost the worst part of it. It's completely automated. A number you've been carrying around, one that was shaped by a job loss or a medical bill, or a period in your early 20s when you didn't fully understand what you were building, has already spoken on your behalf. You didn't get to explain, you didn't get a real conversation, you got a form letter or a brief apology and a list of things you'd need to fix before you could try again. This is what level 1 feels like. Not dramatic, not cinematic, just a quiet, efficient rejection that sends you back out the same doors you came in through. The label the system gives you at this level is high risk. And that label isn't just a credit term, it follows the file. It shapes every option available to you. The lenders who will work with you at this level, and there are some, are not doing you a favor. They are pricing the risk of you. Subprime loans, predatory interest rates, terms are buried in paperwork that a lawyer would need 2 hours to fully explain. The system doesn't abandon you at level 1. It just charges you for the privilege of staying in it. You are not a borrower at this level. You are a liability. And the entire mortgage industry treats you accordingly. Not with malice, but with arithmetic. What nobody tells you at level 1 is that the exit is longer than it looks. Rebuilding credit is not a trick. It is not a loophole. It is 12 to 24 months of consistent, boring, unremarkable financial behavior compounding quietly while life keeps throwing things at you. Secured cards, on-time payments, credit utilization below 30%. Nothing you haven't heard before. The information is not the hard part. The hard part is doing it while rent is due, the car needs work, and the system keeps reminding you through every declined application and every high-interest offer exactly where you currently stand. You are not the problem, but you are carrying the cost of the problem, and the cost is real. Level 2. Low income. You are not denied. That is the difference between level 1 and level 2, and it matters more than it sounds. You are approved carefully, narrowly, with conditions attached to conditions and rates that reflect what the lender thinks of your margin for error, which is to say they think it is thin, and they are not wrong. At this level, you have income, you have some credit history, you have enough of a file that the system is willing to work with you, but work with you is doing a lot of heavy lifting in that sentence. The interest rate you're offered is not the rate you saw advertised. The advertised rate is for someone else. The rate you get is 1.5 to 2.5 percentage points higher, sometimes more, and that difference, stretched over 30 years on a $200,000 loan, is not a rounding error. It is tens of thousands of dollars. It is the price the system charges you for being someone whose income it isn't fully confident in yet. The loan options available at level 2 are narrower. FHA loans become the primary vehicle. Government-backed with lower down payment requirements and more forgiving credit thresholds, they exist specifically for borrowers at this level, and they are genuinely useful. But they come with mortgage insurance premiums that add to your monthly payment for years, sometimes for the life of the loan. The system gives with one hand and takes back a little with the other, and the people who designed it would tell you that's just risk pricing, and they'd be technically correct. What level 2 teaches you that level 1 cannot is that approval is not the finish line. Approval is the beginning of a longer conversation about terms, and terms are where the real money lives. 2 borrowers can close on identical properties in the same week. One walks out paying $1,140 a month. The other pays $1,390. Over 30 years, the difference is not inconvenient. It is transformative. It is the difference between a mortgage that builds equity steadily and one that keeps you treading water longer than you should have to. You are not a liability at level 2. But you are a risk they intend to profit from heavily. The system is willing to bet on you, it just wants to be well compensated for the bet. Level 3. Stable income with average credit. This is where most people live. Not struggling in a way that closes doors, but not thriving in a way that opens them wide. Just steady and employed. A credit score somewhere between 640 and 699. A couple of years of consistent payment history. Maybe a car loan you've managed well. Maybe a credit card you haven't always handled perfectly. The system looks at your file and sees a standard borrower, and standard borrower is the most honest summary of what level 3 is. You are the median. The products were built for you. The process was designed around you. And yet the process still has weight at this level. The paperwork is real. 2 years of tax returns, pay stubs going back 30 days, bank statements for the last 2 to 3 months, an explanation letter for anything that looks irregular, a gift letter. If any of your down payment came from family, the documentation requirement at level 3 is not punitive, it is standard. But standard feels like a lot when you're the one gathering it. The rates you receive are better than level 2, not dramatically, but meaningfully. You're no longer in the territory where the lender is pricing in serious doubt about your reliability. You're in the territory where you're a known quantity, predictable, manageable. The loan officer processes files like yours every week. bank. That familiarity is neither warm nor cold. It is efficient. You are not a problem. You are not a priority. You are a file moving through a process. What this level asks of you more than anything is patience. The approval takes time, the underwriting asks questions, the process moves at its own speed, and your urgency has no bearing on it. You learn to wait, you learn to respond to document requests within 24 hours, because delays at your level don't get absorbed with a phone call the way they might at higher levels. You are playing by every rule, because the rules were written assuming someone at your level needs to be checked carefully. You get the house, the rate is fair, the terms are standard, nothing about the transaction will feel effortless, but it closes, and closing is everything. Level 4, good credit with some savings. Something shifts at level 4, and the shift is not just numerical. Your credit score has crossed 700. You have 3 to 6 months of reserve sitting in an account that the lender can verify. You have a debt-to-income ratio that doesn't make the underwriter pause, and the system for the first time begins to treat you less like someone it's evaluating and more like someone it's trying to attract. The interest rates available to you at level 4 are competitive. Not the best rates in the market, but close enough that the gap between what you're offered and what the most qualified borrower receives is measured in fractions of a percentage point rather than full points. That fraction compounds quietly over 3 decades into a meaningful difference, but the direction has changed. You are no longer the borrower paying a premium for uncertainty. You are the borrower the lender is beginning to price fairly. The options expand. Conventional loans become accessible without the mortgage insurance that follows FHA borrowers for years. Jumbo loans enter the conversation if the property warrants it. The loan officer who takes your file doesn't just process it. They occasionally make a recommendation. They suggest a product that might fit better. They act, however slightly, like an advisor rather than a gatekeeper. The relationship begins to have texture. Your down payment gives you something that transcends the math. It signals to the lender that you have the discipline to accumulate and the restraint not to spend what you've accumulated. Savings are not just reserves at this level. They are character evidence. The system doesn't say that explicitly, but the system is reading it in everything it does for you. You are becoming attractive to the mortgage market at level 4. Not valued yet, not sought after, but attractive. The difference between someone they'll work with and someone they want to work with is closing, and you can feel it in the speed of the process, the tone of the conversation, and the number at the top of the offer sheet. Level 5. Strong financial profile. Pre-approval letters arrive quickly at level 5, not because the lender is cutting corners, but because your file is clean and your numbers are the kind that underwriters move through without friction. A credit score above 740, solid income history, assets that cover not just the down payment and reserves, but also more. The system looks at your file and sees low maintenance and low risk, with a high probability of a relationship that pays them back on time for 30 years without incident. The conversations at level 5 are different in tone. The loan officer speaks to you as a peer in a way they don't at lower levels. They explain options rather than requirements. They present alternatives. They ask about your plans for the property because your plans are relevant to which product serves you best. And they are genuinely interested in matching you to the right product because you are the kind of client who generates referrals and repeat business. You are preferred. That word has financial consequences. It means your rate is sharper, your processing is faster, your exceptions when they arise get escalated to someone with the authority to resolve them. The paperwork still exists at level 5, but it moves differently. Your documentation is clean because your financial life is organized. Nothing in your file surprises anyone. The underwriting questions, if they come, are procedural rather than investigative. You are not being examined for doubt. You are being confirmed for approval. This is the level where the mortgage process first begins to feel like a service rather than a gauntlet. Not luxury service, not private banking, but service, genuine and efficient, from an institution that has correctly identified you as someone worth keeping happy. Level 6, high net worth. The bank knows who you are before the meeting. Not personally, not always, but your profile precedes you in a way that reshapes the conversation before it begins. At level 6, you have assets that extend well beyond the property you're financing. You have investment accounts, real estate equity, business interests, or some combination of all three that gives the lender a picture of someone whose wealth is not dependent on any single income stream. That picture changes everything about how the institution positions itself relative to you. Priority service becomes the baseline expectation at this level, not a perk. You are assigned to a dedicated relationship manager or a private banking contact rather than a general loan officer. The rate conversation is not about what the market offers. It is about what they can do for you, specifically given the totality of your relationship with the institution. If your investments are held there, if your business accounts run through them, if there is existing or potential depth to the relationship, the mortgage rate reflects that. They are not just financing a property. They are pricing access to you as a client. Loan structures become more flexible at level 6. Asset depletion loans allow your investment portfolio to count as qualifying income even if your W-2 income is modest. Interest-only periods become available. Terms that don't exist in the standard product catalog get discussed because your profile justifies the conversation. You are no longer choosing from a menu. You are having a conversation with someone authorized to build something that fits your situation, rather than asking you to fit a product they already have. You are a valuable client at level 6. The institution knows it. You know it. The dynamic of the relationship has inverted from what what it was at the lower levels. You are not asking the bank for access. The bank is asking for your continued business. Level 7. Very high net worth. The rules still exist at level 7, but they bend in ways they don't at any level below it. Not because the rules are corrupt or because wealth buys illegality, but because the rules were written with a standard borrower in mind, and you are no longer a standard borrower by any measure. Your income may be complex. Your assets may be structured across entities, trusts, and accounts that don't translate neatly into a conventional underwriting checklist. And the lenders who work at this level understand that complexity. They have underwriters who specialize in it. They have products designed around it. The paperwork at level 7 does not disappear, but it is handled differently. Your accountant or your CFO provides the documentation. Your wealth manager coordinates with the institution. You are present for the decisions, not the process. The friction that exists at every lower level has been absorbed by the team around you, and by the institution's interest in making this as smooth as possible for someone they don't want to lose. Custom loan terms are a real conversation at level 7. Balloon structures. Portfolio loans are held in-house rather than sold to the secondary market, which means the lender's own criteria apply rather than Fannie Mae's. Bridge financing is arranged in days rather than weeks. The speed of everything at this level reflects the institution's understanding that your time is a scarce resource, not their money. They have capital. You have options. The product they offer you needs to justify your presence, and they know it. You do not wait at level 7. The process waits for you. Level 8. Ultra wealthy. There is no application at level 8, not in the way anyone below this level would recognize. There is a conversation, a call between advisors, a term sheet drafted by a private credit desk, a family office, or a relationship that exists outside the retail banking system entirely. The mortgage, if it is even called a mortgage, is a negotiated instrument between parties who each bring something the other wants. You bring capital, relationships, and the possibility of a long-term financial partnership. They bring structured financing at rates and on terms that are simply unavailable to anyone whose balance sheet doesn't justify the conversation. The ultra-wealthy borrow not because they need to, but because borrowing is cheaper than liquidating. Selling an asset triggers taxes. Taking a loan against the asset preserves the position, maintains the tax profile, and costs a fraction of a percent annually in interest, particularly when the loan is structured against a portfolio of assets rather than a single property. At level 8, the mortgage is not a product, it is a strategy, and the people designing it are not loan officers. They are structurers, private bankers, and advisors whose entire function is to make sure capital moves in the most efficient direction possible, given your specific situation. Exclusive financing at this level means deals that don't exist in any brochure. Loans against art, loans against private equity positions, credit facilities that function as revolving liquidity against a diversified asset base. Terms that are renegotiated not on a fixed schedule, but as the relationship evolves and the market shifts. The institution is not servicing your loan. It is managing a relationship with someone whose total financial footprint justifies dedicated resources, dedicated attention, and dedicated flexibility. At level 8, the question is never whether you qualify. The question is what structure serves you best, and the people answering that question are paid specifically to make sure the answer is correct. You are not a borrower at level 8. You are a counterparty, and counterparties don't wait in lobbies. They don't pull numbers. They don't get form letters. They get phone calls. They get solutions. They get a system that was built, in many ways, with exactly them in mind. The machine that processed the denial at level 1 is the same machine that drafts the private term sheet at level 8. It was never neutral. It was never blind. It simply responds to what you bring to it. And at level 8, what you bring is everything.